Now, to provide an in-depth look on what's happening in the housing market and give you the insights and trends impacting the global economy, my favorite economist, the funniest economist out there, granted, not a really high bar, but nonetheless, Mr. Rick Sharga.
I can't see any of you. Welcome to the happiest place on earth. Good morning. No, you didn't see me in Napa, did you? I will not start until I get a rousing side-by-side good morning. So good morning. Good morning. That's better. Guy promised me a live audience. I was just checking. In case you're wondering why they call this the happiest place on earth, it's the only place I know where people will happily stand in line for about a half an hour to pay $7 for a churro. And so it is a very, very happy place if you're collecting the money. I also wanted to thank Guy and Jay for not putting any pressure on anything I'm about to say. Trust me, this whole thing isn't jokes. But they both said I have to be funny, so if I'm not, you will share that belief with my teenage daughter who doesn't think anything I say is funny. I did want to comment on something Guy said on a more serious note about dreams. I thought Guy's opening comments were great. And it's so refreshing to see a CEO of a company be that transparent and that personal and talk about dreams. You have one of the best CEOs I've ever met. And when Walt Disney opened this amusement park, which, that's what my kids grew up thinking Disneyland was, because we're here in Orange County. That's the local amusement park. Talk about spoiled. His opening comments were to all who come to this happy place, welcome. And I hope he didn't spend too much time writing that. But later in his comments, he talked about Disneyland being a place where you could savor the challenges and promise of the future. And I can't think of a better organization than SIDE, and all of you SIDE community folks, in terms of looking at that future of real estate and the challenges and promise that lie ahead. I also want to thank SIDE. My family have been pass holders here since my kids were small, so for about 20 years, we've been making your Disney stock go up. And this is the first time I've ever had Mickey Mouse ears. And these are a gift from SIDE. It's even, my name's embroidered on the back, I'm so proud. And I get really good reception on the radio there. So I'm Rick Sharga. I'm an executive vice president of market intelligence with ATOMM. We're a data company that provides real estate mortgage data, crime rates, school ratings, climate change, you name it, we provide data. And I'm here to talk about a number of things. We're gonna talk about hidden Mickeys. And so some of you know what we're talking about. How many of you before this week have been to Disneyland before? Okay. How many of you have looked for hidden Mickeys? Ooh, not many. We're going to talk about the U.S. economy from recession to recovery to recession, maybe. We're going to take a look back at 2021 and where we are so far in 2022. Very briefly touch on commercial real estate, because I know some of you do dabble in commercial a little bit. We're going to ask, where are all those tens of millions of foreclosures that the press was talking about last year? And then we'll do some closing thoughts. So we're going to go through this pretty quickly. For those of you who I've not had the pleasure of presenting to before, I have probably 2 hours of stuff crammed into the next 31 minutes. So I'm going to go very, very quickly. Happy to answer questions afterwards. Happy to respond to emails or texts later. And I know the SIDE folks will make this presentation and the materials available for anybody who wants them. If you've ever been to a Disney facility, there are hidden Mickeys everywhere in the park. And I'm bringing up the notion of hidden Mickeys because these are things that are in plain sight, but if you're not looking for them, you might miss them entirely. And these are just 3 examples you'll see in Disneyland and in California Adventure. And if you look at the one in the middle, that's actually something you'll see on Space Mountain. It's on the top of the cars, so you can't really see it when you're in the ride, but when you're waiting in line for 7 hours to get on the ride, you'll be able to look down and see that little Mickey Mouse thing. They arrange the speakers in a way that look like Mickey Mouse ears. If you're at a Small World, which was my mother's favorite ride, and we always, as a family, we always do It's a small world when we visit Disneyland in honor of Nana, who's no longer with us. The gears on the front of the building are actually a hidden Mickey. And if you happen to go over to California Adventure, where you'll be for the party tonight, and go to Mater's Junkyard, and I love Mater because his name's just like Mater without the T, you'll see that they have some hubcaps fashioned in Mickey Mouse ears. There are thousands of these across Disney properties everywhere, and you're looking at them. There's curtains in our hotel room that the pattern is Mickey Mouse ears. And if you're not looking for them, you miss them. And we're going to talk about some hidden Mickeys in the economy and in the housing market today as we go through things. So what's going on in the US economy? Well, we've had the most remarkable recovery in the history of the US economy when it comes to recessions. For those of you who don't remember, we had this pandemic thing declared a couple of years ago. The government shut down pretty much everything, and our economy dropped. The GDP dropped by about 31%. In a quarter. It was the single biggest drop in the GDP in the history of the US economy. Bigger than the Great Recession, bigger than the Great Depression. And the good news is we were kind of prepared for it. There was a lot of government stimulus that went into keeping this from being a deep and long-lasting recession. There were a lot of other programs that were put in place to try and help with the recovery. And in fact, the next month, the GDP grew by almost 34%, which was the biggest single month-over-month increase. Now, for those of you like me who are sometimes challenged with basic math, a 31% drop followed by a 33% increase does not get you back to where you were. But you get really, really close. And since then, we've had 6 consecutive quarters of continued GDP growth. So we fully recovered from the drop-off in terms of the GDP. We're probably not where we would have been if we hadn't had that decline and rebound, but GDP numbers are doing very well. One of the reasons for that is the robust nature of consumer spending. So those $7 trillion that we injected into the economy, a lot of which were in the form of stimulus checks, enhanced unemployment benefits, things like that, a lot of that got spent. And the US GDP is 70% based on consumer spending. So the notion that consumers came back as strongly as they did, spent as much as they did, and even during the pandemic, this wasn't all on paper towel and toilet paper. So there were a lot of things being bought. It's one of the reasons we're running into some problems today because there's a lot of cash. The savings rate of US citizens is at one of the highest levels we've ever seen in history. And in fact, the banks are sitting on mountains and mountains of cash that they don't know exactly what to do with. I keep telling them to send it to me, but they don't. But we've seen this kind of robust, remarkable recovery. One of the reasons for that is almost everybody has their job back. We went from 3.5% unemployment immediately prior to the pandemic, which was the lowest unemployment rate we'd had in about 50 years. We went from that to almost 15% unemployment in about a week, which is just unprecedented. A couple things were very different about this recession. One of them was that the job losses were focused on a handful of industries, service industries, retail, restaurants, travel, tourism, hospitality, entertainment. One of the things that those employees in those industries had in common was they tend to be younger, they tend to have less formal education, they tend to have lower salaries. And because of those factors and a few other factors, they tend much more often to be renters than homeowners. So a lot of the dire predictions about what was going to happen to the housing market as we shed 22 million jobs in a week, one of the reasons that didn't happen was because the people that lost their jobs were predominantly renters, not homeowners. And there were a lot of renter protection programs put in place by the government, you might remember. But fast forward to January and February of this year, and unemployment is back down to about 3.8, 3.9%. It would be a little bit lower, except that we've seen more people start to come back and re-enter the workforce. So you'll probably see unemployment rates bounce around a little bit. I don't think they'll get much ahead of 4% anytime soon. But when you see them go up a tick, don't be too concerned because in most cases, it just means that more people who hadn't been looking for work are now back in the workforce looking for a job. And that's a good thing because there are still more jobs available than there are people looking. That's something that doesn't happen that often. The ratio right now is there's about 1.5 jobs available for every one person who's looking for work. There's some disconnects. Some of the jobs that are available don't connect well with the skill sets of people who are looking for work. There's a geographic disconnect. Some of the jobs are available in places where people are not. But by and large, both unemployment claims and continuing unemployment claims have come down. We will have regained 100% of the jobs lost, 22 million jobs, in less than 2 years. That's probably the fastest recovery we've ever had from a recession. In contrast, the Great Recession took us 10 years to get the jobs back. So the end of the Bush administration, the entire Obama administration, the beginning of the Trump administration, and that was when unemployment peaked at about 11%. So this recovery has been nothing short of phenomenal. On the other hand, not everything is rosy. The last time we met, I told you inflation was under control. Turned out I lied. Inflation is actually not under control, it's a runaway train. This is the highest inflation we've had in about 40 years. Part of it is because we did inject $7 trillion into the economy in about 18 months. And people back then were asking me, won't that cause inflation? And I said, well, it should, but they say it's not. Well, they lied too. And President Biden, and I'm not picking on President Biden, I'm nonpartisan, okay, was asked about inflation, I think during the State of the Union or right after, and said he had the solution. We were going to lower the cost of goods and services. I thought, well, okay, that's the definition of how to fix inflation. Do you have a way to do that? And I think the rocket scientists in the economic group in the federal government are figuring out that. But the inflation was not something that is a partisan problem. This is because of supply chain disruptions around the world. You are within a 20-minute drive or a 40-minute drive, depending on traffic, of ground zero in terms of supply chain disruption. There are still dozens and dozens and dozens of tankers lined up at the Port of LA, the Port of Long Beach, waiting to unload goods. And that's endemic of what we've seen in terms of supply chain disruption. So all that money, it's in the bank that people would like to spend, they can't find things to buy. So the economy is kind of a macrocosm, if you will, of what's going on in the housing market. And you have people looking to buy stuff, and there's nothing to buy, so prices go up. And so inflation is an issue, and it's one of three things that I call a triple whammy on home buyers. We have rising interest rates, we have rising home prices, and we have a 40-year high in inflation. That makes it tough, particularly for first-time buyers, to get into this market. We'll talk a little bit more about that. And that leads us to the first hidden Mickey in the economy, which is consumer confidence. Now, these numbers come out regularly from the University of Michigan, so they're again they're in plain sight. You can see them all the time. Prior to the recession, prior to the pandemic, it wasn't unusual for that index to be at 100 or more. That's a sign of really strong consumer confidence. The last reading was at 62.8. Which is as low as it's been in decades. And there's another triple whammy going on here. It's not just inflation, although that's one of the problems. The consumer confidence has gone up and down with every wave of COVID. So we're one more wave of COVID away from consumer confidence tanking again. And then the third thing, of course, is Russia's invasion of Ukraine. So consumers are under a kind of heavy cloud right now and a little bit concerned. One of the interesting things of this cycle is that consumer confidence and consumer spending usually go hand in hand. But consumer confidence right now is very weak, and consumer spending continues to be very strong. So it's worth looking at that as we go forward. If consumers decide suddenly they can't afford to buy anything anymore, and are there any mortgage people here today? Because I need to take out a second mortgage before I leave because I have to fill up my gas tank on the way home. So if consumers do decide at some point to stop spending as much, that could lead us into kind of a weakening economy, maybe even a recession, so something to consider. So what's the Federal Reserve going to do? Chairman Powell has been very judicious about both statements and about actions. And so I am hopeful that the Federal Reserve will not do what it has done in the past and overcorrect. I'm originally from the East Coast. For those of you from the East Coast or Midwest, you understand winter driving. And if you're on an icy road, there's two ways to stop your car. The preferred way is to tap quickly and softly on your brakes and come to a controlled stop. That's, if you're ever in snow and ice, that's what you should do. The other way, not as good, is to slam on the brakes and skid into a ditch. And the Federal Reserve, historically, when it comes to correcting inflation, has a tendency to go off the road into a ditch. They overcorrect, they slam on the brakes. There are people now calling on the Fed to do multiple 50 basis points increases in the Fed funds rate. there's a ditch waiting if we do that. So there is a chance that the Fed, as part of its efforts to get inflation under control, to keep the economy from overheating completely, might overcorrect. And this is leading to hidden Mickey number 2, which is something called a yield curve inversion. And I know you're all going, oh God, economics. A yield curve inversion happens when long-term interest rates trade places with short-term interest rates. If you're borrowing money, you should pay less interest on a short-term loan than on a long-term loan, because a long-term loan, the lender's taking on more risk. Every time those two rates have reversed places, and this chart shows the 2-year bond and the 10-year Treasury bond, every time they change places, a recession follows. It's not because of anything in this chart. It's not because of the rates themselves. This is just a metric people look for. And we are very, very close right now to having that happen. It's very, very likely it will happen if the Fed goes through with its planned 6 rate increases over the next year. Doesn't mean we'll definitely have a recession. If it happens, it doesn't happen overnight. It's typically within something like 9 to 16 months. After the inversion, but it is something to watch for. So is a recession inevitable? Not necessarily. Wouldn't be a huge surprise. Most of the recessions, if you look at this chart, which goes back into the 1970s, tend to be fairly short-lived and tend not to be very, very deep. Might not affect us that much because the underlying economy right now continues to be pretty strong. And that's been shown in the housing numbers. We sold about 6.1 million existing homes last year. I think you guys sold about 5.9 million of them, based on what Guy was saying earlier. So it was a strong year. It wasn't a record year, but it was a good year. And unfortunately, 2022 is not off to a banner start. February, in fact, marked the 7th consecutive months where on a year-over-year basis, we've sold fewer homes than the year before. Now, some of that is because the pandemic threw the cycles off a little bit, but I can't view 7 consecutive months of year-over-year declines in a positive light. Part of it is definitely due to lack of inventory. And you might have read recently that maybe housing inventory has bottomed out and is on its way back up. That may be true, but I really what we're doing right now is falling a little more slowly rather than rising. So one of the reasons people ask if we're looking at another housing market crash, if we're in a bubble. I don't believe we're in a bubble. I don't believe we can keep home prices going up 20% a year indefinitely and not get to a bubble, but I don't think we're there yet. One of the reasons is that red line that you see in the middle of the chart that kind of spikes up. That shows months' supply of inventory. Now, in a normal market environment, there's about 6 months of homes available for sale. Where that red line spikes is right before the market crash back in 08, 09, 2010. We had over a year's supply of homes available for sale, and that's not counting stuff that was coming in from foreclosure. So there was just way more inventory than people could buy. Contrast that with where we are at the end of this chart, the red line at the far right-hand side. We're at less than 2 months supply. So we're running at about a third of the inventory available. That's why homes are flying off the shelf as soon as you list them. And that's for those of you who actually list them and don't sell them, then put them on the MLS and close immediately. I know nobody here is doing that, but for your counterparts who are, but we're still way below in terms of inventory. New home sales last year, we would have probably surpassed 800,000 if there had been enough inventory to buy. But you can see that new home sales, as we move into this year, are also trending the same way existing home sales are. In fact, we had a huge drop-off, a 19% drop January to January in new home sales. February numbers were down from January and from the prior year. I really do believe this is entirely based on inventory. And again, I know you're getting sick of charts, but if you look at the red line on this one, this is the lowest percentage of new homes completed and available for sale since they started keeping these records in 1973. On the other hand, and this is the first time I've really been using this chart, so this is kind of fascinating to me anyway, we have the highest percentage of homes for sale, new homes for sale, while they're still under construction or even before the ground has been broken. Now, the builders stopped doing this for a while last year because of supply chain disruptions. And the reason for that is they couldn't commit to a completion date of the house. If it's taking you 6 months to get roofing materials, 9 months to get windows, a year to get appliances, and I know you've all heard this, really hard for the builder to say the property is going to be completed October 1st. And in fact, a lot of what's keeping these numbers a little bit goofy right now, and that's a Disneyland pun, not an economics term, is that it's taking longer for builders to finish construction on these properties than it normally would. The other thing that's a problem for builders is they don't know what the goods are going to cost when it comes to building a house. So a lot of new home construction contracts right now are coming with a clause that says this property might be 20 or 30% more expensive than what you're thinking it is. So one of the hidden Mickeys I don't have in today's presentation, but I'll give you as a side comment, you like that? Is watch for data on contract cancellations in the new home market. We're actually starting to see a little bit of a spike in that because you just signed a contract to buy a house, the price is now 30% up. That gives you an out of that contract, and I think we're going to see a little bit more of that. The good news on this front is housing start numbers have been very encouraging. I'm actually starting to read stuff in the press, and this is almost as dopey, another Disneyland, this is almost as dopey as what we saw last year with there's going to be 20 and 30 million people foreclosed on and evicted, and I said no. And now what we're seeing is there's going to be an oversupply of housing. No, there isn't. Not anytime soon. The builders would have to be building 8 million homes a year for that to be, not really 8 million, don't take that one. It's, and they couldn't do it anyway because they don't have enough labor and they don't have enough capital. But the good news is we're moving in the right direction. 1.6 million housing starts most recent months, but the builders haven't built for 10 years. So depending on whose numbers you believe, we're somewhere between 3 and 6 million units short of what demand is, and the demand is real. This is not 2006 again, where there was a lot of speculative buying going on. This is demographics. So the largest group of millennials, who's the largest generation in US history, is between the ages of 29 and 32. Guess what the average age of a first-time homebuyer is? 33. So this group is all marching headlong into household formation and into home buying age. It is also convenient. I get to blame the millennials for the problems, and I think we should blame the millennials for pretty much everything. Oh no offense. I mean, nothing personal. You're younger. You're better educated. You're better looking. I hate you all. I hate you. Interest rates are continuing to rise, and to show you how goofy this is from Freddie Mac on March 24th. The average loan rate on a 30-year fixed was 4.42%. A week prior, it had been 4.18%. Right before I came on, I was looking. Yesterday, we almost hit 5%. I believe we will be over 5% by the end of the year. Not by much, but I think we'll probably be somewhere between 5.25% and 5.5%. Now, before you panic, that's still at the low end of rates historically. My first house actually had 2 digits on the left side of the decimal. And we actually managed to buy a house. What this will do, however, is continue to put price pressure on people looking to buy. And so one of the other hidden Mickeys we'll get to in a second. The rising rates and the rising prices have affected affordability. So this is a chart from a friend of mine who's a chief economist at First American. And he charts what he calls house prices versus real house prices on an index. And real house prices factor in wage growth, and they factor in interest rates. And for a number of years, affordability was buttressed by those very, very low interest rates, 2.5%, 3% interest rates. You start getting up to 4.25%, 4.5%, 4.75%, all of a sudden the effect those interest rates have on affordability is going in the opposite direction. So for the first time, we're actually starting to see those real home prices go up, even despite the fact that wages are going up. And again, I mentioned that triple whammy because now you have to factor inflation in as well. Everything's more expensive. Story on the news here locally last night that car insurance rates are expected now to go up 20, 30, or 40%. So it's not bad enough that you can't afford to put gas in the car, but now you can't afford the car. And it's because car prices have gone up. So it's going to be more expensive for the insurance companies to replace or repair your car now. So one of the hidden Mickeys I look at, I talked about demand continuing to be strong, but this is a sign that we may be starting to hit what I call an affordability wall, and people are just looking up and saying, no, that's too much, and kind of backing out of the market. And the Mortgage Bankers Association puts out an index weekly of mortgage purchase loan applications. And I know this one's a bit of an eye test, but if you can see the yellow line there, that's this year, and you can see we're running behind both 2020 and 2021 numbers in terms of loan applications. So fewer people are taking out loans. You probably saw something about pending home sales being down a little bit. And they probably talked about maybe 4 consecutive months. It's actually a little bit worse than that. So not only are the pending home sales, and this is from the NAR, they put out something on contracts closed for people looking to buy houses. And what we're seeing, if you look at it on a year-over-year basis, is we're now up over 8 months in a row where there are fewer people signing contracts, so the pending home sales have been down a little bit longer than what you're reading about. So that's kind of hidden Mickey number 2 in terms of demand. One other hidden Mickey, and this, for those of you in California, and I know a lot of you are from California, I kind of look at California as a bellwether when it comes to real estate across the country. So what happens in California has a tendency to spread a bit, and this is something worth watching. But for the first 2 months of the year, the state's been down in terms of the volume of sales by about 8.2, 8.3%. So we may have, and Southern California, which sells more houses than any other part of the state by a lot, is actually down almost 10% year over year. Still a lot of homes being sold. Prices have not been impacted. Prices are still going up. So I don't think we've peaked in terms of pricing yet. But is anybody here besides me old enough to remember what we used to call a normal housing cycle? So a normal housing cycle is you get more demand, prices go up as sales go up. You get to a certain price point and people say, nope, that's too much. Sales weaken, prices moderate, and the cycle starts all over again. That's called a normal housing cycle for those of you under the age of 40. We may be approaching something like that right now. So I'm not looking at a housing crash. I'm not looking at prices falling through the floor. None of the indicators, none of the predictors we look at suggest that might be happening. But I do think we're getting to an affordability issue where a lot of buyers are going to kind of vote themselves off the island, at least temporarily. We also have something that economists refer to as rate lock. So if you're in a $1 million house in California with a 2.5% or a 3% interest rate on your loan, I'm not sure you're all that incented to go buy a $1.4 million house with a 5% loan. So you're going to have some people that are kind of going to decide to stay put. Might be a good time to go buy Home Depot and Lowe's stock. Don't take my stock advice. But that's something else we take a look at. And again, not predicting that we're going to see a crash, not predicting that we're going to see the bottom fall out, just predicting it's going to get a little tougher. For some of you in some of your markets, that means you're only going to have 20 people bidding instead of 30. So that's not the worst thing in the world. And as I mentioned at the last side-by-side event, you know, you guys are the best of the best. The people that usually, the realtors that usually have difficulty during a weaker cycle or a down cycle are not the best of the best. They're the people kind of doing this as a hobby. But I think during times when it's a little harder to sell a property is when the best agents are the ones who tend to capitalize. So I think you're the best positioned group that I'm probably going to speak to this year in terms of being able to weather whatever difficulties we might hit. For those of you interested in the commercial market, and I don't say that to blow smoke, I really mean that. It's the success this organization has had is because of the people that have joined it, the groups, the businesses that have joined it. You guys have done a tremendous job. Despite Guy. For those of you who are interested in commercial, we closed last year with a full recovery in commercial. In fact, it was going gangbusters. Over $800 billion in commercial sales last year. The fourth quarter is always a banner quarter in commercial because people save their budget, have to spend it all at the end of the year. And this was the strongest fourth quarter in decades. So both in terms of volume of commercial property sold and prices, pretty much a record year last year. For those of you who do dabble in commercial, the multifamily market, I don't think most of you are selling industrial properties. That's been the hottest market because of e-commerce and because of cloud computing, because people are working from home, and because of the cannabis industry, which has had an enormous, enormous appetite, not just for Doritos, but for industrial warehousing space. But the multifamily market might be one where you cross paths with commercial. Multifamily vacancy rates were at 2% last year, which is historically low. There was nothing available for rent. So these properties were selling like hotcakes. record highs in terms of commercial property sales in the multifamily space. A lot of retail properties are being sold and converted into multi-use facilities. So not just strictly retail anymore, but maybe retail, maybe office space, and in some cases, even residential units. So we've seen some really creative reuse of commercial space. I wouldn't be surprised to see shopping malls converted into multi-use facilities, senior living maybe, because everything you need is within walking distance, enclosed, and it would make my mom right one more time. Because when I was a teenager, she said, why don't you just live at the mall? You're there all the time anyway. And now I can. So, but again, there's lots of opportunities, I think, for small dollar commercial, for those of you who are interested in that space. I'd also be looking at office and hotels at the low end, because a lot of those are owned by small individual investors who probably had to struggle to meet their financial needs during a couple of years of challenges due to the pandemic. Foreclosures are recovering a little bit in the commercial space. There aren't a lot of commercial foreclosures, but they have come back more quickly than residential foreclosures have. And again, I think these tend to be lower dollar properties that the owners just can't manage their way through. I mentioned the apartment market was crazy. I didn't mention earlier demographically that right on the heels of the millennials are Gen Z, the oldest folks in Gen Z, oldest, 27. But they're forming households. A lot of them are forming rental households. So right here in Orange County last year, the asking price for an apartment went up by 17%. Nationally, it was about 13 or 14%. And keep in mind, this is in a part of the industry where the average annual increase on asking rents is between 1% and 5%. So 14%, 17%. If you're in Palm Beach, Florida, 27% year-over-year increase. Unprecedented, just completely off the charts. This has a dual-edged sword kind of thing for you guys. Because on the one hand, you can make an argument, and actually ATOMM, my company, has put out reports that showed in over 60% of the counties across the country, it's actually more economically advantageous to own a property and make monthly mortgage payments than it is to rent and make a monthly rental payment. So there is that. And as rents go up, that ratio probably works in your favor. On the other hand, while these people are paying out rent and the rents keep going up, they have less money to put down for a down payment. So it makes it harder for them to enter the market. So just thought you might be interested in that data. So for those of you who joined us in Napa, what a great event that was too, by the way. Although I got to say, Guy, you're not helping my ego very much. Well, when I was coaching Little League, my son was kind of an all-star. So for a number of years, I was Christopher's dad. And then when my daughter was in the choir in high school, she was a featured soloist. So I was Jacqueline's dad. And you keep inviting me back, but now I'm Gwyneth Paltrow's warm-up act. I know that's why you're all here, So I'm having an identity crisis, Guy, and if there's somebody out there who can give me a hug later, that'd be great. But in Napa, I was ranting about the fact that you can't believe the headlines. There were probably well-meaning but badly informed reporters who were talking about 20, 30 million people being evicted, foreclosed on, and it just wasn't going to happen. There had been blood in the streets if that had been the case, and probably deservedly so. So instead of that, what we saw last year was the lowest percentage of homes in foreclosure in history. So I was actually right on something, despite what my wife will tell you. There was a forbearance program that gave people the opportunity to not make mortgage payments if their income had been impacted by COVID. 8 million people entered that program between the time it started and when you could no longer apply. There's just over 500,000 of them left. So we've seen a steady decline since the peak. There were some economists who were predicting that 35% of borrowers would enter that program. That would have effectively bankrupt the mortgage servicing industry and made it impossible for anybody to get a loan. So we peaked at about 8%. So fortunately, that was a bad forecast. Of the 8 million people who entered the forbearance program, 83 left with some sort of plan in place. A surprisingly high percentage, about 20%, never actually missed a mortgage payment. So they entered forbearance just to hedge their bets, just in case something bad happened to them financially, but they never actually missed a mortgage payment. Another 10 or 12% of them actually just had their loan reinstated. So they went right back to paying what they'd paid before, and they actually paid back what they had owed. The rest of the people are either selling their property, refinancing their loan, entering into a loan modification program, or in some cases, taking advantage of the government's deferral program, which means you can take all of the payments that you missed and tack them on to the very end of your loan. So if you're in year 5 of a 30-year loan, you don't have to worry about making these missed payments for another 25 years or until you refinance or sell the house. Remarkably successful program. In the 20 plus years I've been in the industry, probably the best example I've ever seen of the government and the mortgage industry working together to achieve a positive outcome. Of all these people who've left, less than 1% left via short sale, deed in lieu, or default. After they've left, 82% of them have remained current on their loan payments. So if you're waiting for that wave of foreclosures for your investor buyers who are looking for below value properties, or your consumer buyers who are looking for something they can afford, not a lot looks like it's coming out of the system. Contrast this with the Great Recession, when about 50% of loans that were reworked failed, when over 50% did. So again, just not seeing a lot of carnage that you might have expected. Delinquencies are still elevated, but it's a little bit of a false flag here. So when the pandemic hit, we had a lot of people jump into this forbearance program. I mentioned during the whole period, it's been about 8 million people. Even though the government program said they couldn't be reported late to the credit bureaus for missing payments, the industry still marked their mortgage payments as being delinquent. Now, it's not impacting their credit, it's just kind of keeping score. So that green bar you're seeing there is seriously delinquent loans over 90 days delinquent. And that spiked to a number that was even higher than we saw during the Great Recession, but it was false for 2 reasons. One is what I just talked about. People were actually allowed not to make their payments, so they were being counted in that cohort. And also, nobody was allowed to foreclose. So some of these seriously delinquent loans normally would have rolled over into foreclosure, but they weren't allowed to, so they got stuck there. So what we've seen now is about 10 consecutive months of delinquencies continuing to come down, especially those serious delinquencies. In a normal market, about 4% of loans are delinquent, and another 1% are in foreclosure. At the peak of this mess, we were at about 8% that were delinquent. Now we're down to about 4.5%. So we're almost back to normal, and the trends suggest we're going to continue going in the right direction. Foreclosure activity, normally I said 1%. We were down to about 0.25% of loans in foreclosure, and virtually the only things going into foreclosure during 2021 were vacant and abandoned properties or commercial loans that didn't have the same kind of government protections. Since then, we've started to see foreclosure activity come back after the moratorium ended the end of July, as people are exiting the forbearance program, and as the CFPB's enhanced servicing guidelines, which basically said don't dare foreclose on anybody, expired at the end of December. So you'll see these headlines at least for the next 5 or 6 months, where every month we're going to see a double-digit increase in foreclosure activity from the previous month and a triple-digit increase from the previous year. So you're going to see crazy things like 169% increase year over year. But keep in mind, if we went from 2 to 4, that's a 100% increase. So that's really what we're dealing with, is a really, really low base. We will not be back to normal levels of foreclosure activity until the end of this year, or maybe even the beginning part of next year. So if you have investors or buyers waiting for that kind of distressed inventory to hit the market, tell them not to wait. But reach out to homeowners who are in foreclosure for listing leads, because 90% of borrowers in foreclosure today have positive equity in their homes. Almost a third of them have more than 50% equity in their homes. A lot of them don't know they have the option to sell, even though they have all that equity. So realtors, good realtors, can perform a really valuable service, help these people avoid a foreclosure, get a listing themselves, walk away with a big check in their pocket, the seller, and get a fresh start. So there are some opportunities in this category, and there are foreclosures everywhere. Wrapping up, because I'm out of time now, just to recap some of the things we talked about. Most economic metrics are still strong, but undeniably there are signals we could be in for a recession. Probably not a big one, but keep that in mind. Global events could skew things. Who knows what's going to happen next? I didn't expect a pandemic the first time I talked to you guys. I certainly didn't expect Russia to invade Ukraine in between. But that's going to goof up the supply chain. China's had another COVID outbreak, so who knows what's going to happen. Inflation, higher mortgage rates, rising home prices, I mentioned, are a triple whammy. The commercial market recovery is continuing, and it's going to continue at different rates in different industry sectors. And foreclosure activity is going to increase steadily, but won't be back to normal levels probably until the beginning of next year. And here's my tip for you. As you go to the parks, if you're only going to be at Disneyland for one, well, first of all, if you're going to do Ride of the Resistance, figure that's pretty much all you're going to do all day. And so spend 2 days. It's worth going on the ride. But if you're only going to be there for a day, make sure you get the Genie Plus app. I hate to give Disney more money. But if you don't do that, you're only going to be there for one day. You're going to miss out on a lot of the best rides. So I want to thank Guy, Hillary, and Ed for having me again. I want to thank you all for your attention. Enjoy the rest of your trip.